Welcome to your NMLS Safe Exam Prep video series. I am your instructor for this course. Together, we are going to make sure you walk into that exam room fully prepared, confident, and ready to pass. This is video 1 of 10. Today's topic is RESPA, the Real Estate Settlement Procedures Act. RESPA is one of the most heavily tested laws on the NMLS exam. Master this topic and you are already ahead of most candidates. RESPA stands for the Real Estate Settlement Procedures Act. It was enacted in 1974 and is implemented through Regulation X. RESPA has one primary mission: protect consumers from abusive practices in the mortgage settlement process. It is enforced today by the Consumer Financial Protection Bureau, the CFPB. RESPA governs three major areas. Number 1, kickbacks and referral fees. Number 2, disclosure of settlement costs. Number 3, the servicing of mortgage loans after closing. The most important rule in all of RESPA. Write this down. You may never give or receive anything of value in exchange for a referral of settlement service business. Say it with me. Never give or receive anything of value in exchange for a referral. Never give or receive anything of value in exchange for a referral. That is Section 8 of RESPA, and it is the foundation of almost every RESPA question you will see on the exam. Section 8. Kickbacks and referral fees. Here is how the exam tests this. A title company sends gift cards to real estate agents who refer business to them. RESPA violation. A lender takes a real estate agent to dinner after a closing. Potentially a RESPA violation depending on the pattern. A mortgage company pays another company for marketing services, but the real purpose is to compensate for referrals. RESPA violation. These scenarios all have one thing in common. Something of value was exchanged in connection with a referral. Now, what counts as a thing of value? The definition is extremely broad. Things of value include cash, gift cards, meals and entertainment, golf outings, travel, software licenses, below-market rent, discounts on personal transactions. And here is the one that surprises most people. A business referral back is itself a thing of value. Two companies sending each other referrals in exchange for receiving referrals, even with zero cash changing hands, that is a RESPA violation. Now the exam's favorite trick about Section 8. There is no dollar threshold. There is no de minimis exception. A $5 gift card given in exchange for a referral violates RESPA just as much as a $5,000 payment. The amount does not matter. The exchange is the violation. Repeat this. The dollar amount is completely irrelevant. What matters is whether something of value was exchanged for a referral. Now let's talk about the Affiliated Business Arrangement, or ABA. An ABA is when a settlement service provider has an ownership interest in another provider and refers business to them. Under RESPA, this is not automatically illegal, but it requires all three of the following requirements to be met simultaneously. Requirement 1. Written disclosure must be provided to the consumer at or before the time of referral. Requirement 2. The consumer must not be required to use the affiliated provider. Requirement 3. The only compensation received must be a return on the ownership interest, not a per-referral payment. All three, all at the same time. If anyone is missing, RESPA violation. Marketing Services Agreements, MSAs. An MSA is a written agreement where one settlement service provider pays another for marketing or promotional services. The CFPB has scrutinized MSAs heavily because they are frequently used as a disguise for illegal referral payments. The key question the CFPB asks is this: does the payment reflect the fair market value of genuine services actually performed? If a title company pays a real estate agent $300 a month for 2 social media posts, and $300 is far above market value for 2 posts, the excess is a disguised referral fee. Section 9 of RESPA. Short and very important. A seller cannot require a buyer to use a specific title company as a condition of the sale. If a seller puts it in the contract, you must use Southwest Title or the deal is void. That violates Section 9. The penalty for a Section 9 violation is 3 times the charge for the title insurance. On the exam, if you see a seller dictating the title company choice, think Section 9. Section 10 of RESPA. Escrow accounts. When a lender collects money monthly for taxes and insurance, that money goes into an escrow account. RESPA limits how much extra, called a cushion, the lender can hold above what is needed to pay the bills. The maximum escrow cushion is 2 months of projected escrow payments. 2 months. The lender must conduct an annual escrow analysis. If the cushion exceeds 2 months, the excess must be refunded to the borrower within 30 days. Section 6 of RESPA, Qualified Written Requests, also called QWRs. A QWR is a written request from a borrower to their loan servicer asking about the servicing of the loan. When a servicer receives a QWR, 2 deadlines apply. Deadline 1. The servicer must acknowledge the QWR within 5 business days. 5 business days. Deadline 2. The servicer must respond substantively within 30 business days. The 30-day deadline can be extended to 45 days if the servicer sends a notice of extension before the deadline expires. Exam traps. These are the RESPA mistakes that cost candidates points. Trap 1. There is no dollar threshold. Even $5 exchanged for a referral is a violation. Trap 2. The pattern matters. 1 dinner may seem innocent. 8 dinners, each followed by a referral, is evidence of a kickback arrangement. Trap 3. Employer-to-employee payments are exempt. A company paying its own employees' production bonuses is not a RESPA violation. Trap 4. The ABA exemption requires genuine free consumer choice. A builder requiring buyers to use the affiliated lender eliminates that choice. Key numbers. Commit these to memory right now. Section 8. No dollar threshold, no de minimis exception. Section 9 penalty, 3 times the title insurance charge. Section 10. Maximum escrow cushion is 2 months. Section 6 QWR. Acknowledge within 5 business days, respond within 30 business days. Maximum statutory damages for QWR violations, $2,000 per violation. Section 8 civil liability, 3 times the charge for the settlement service, not 3 times the kickback. Quick recap before we finish. RESPA, Real Estate Settlement Procedures Act. Regulation X, enforced by the CFPB. Section 8. Never give or receive anything of value for a referral. No dollar threshold, no exceptions. Section 9. Sellers cannot require buyers to use a specific title company. Section 10. Escrow cushion maximum is 2 months. Annual analysis required. Section 6. QWR. Acknowledge in 5 business days. Respond in 30. ABAs. All 3 requirements must be met. MSAs. Payments must reflect fair market value of actual services performed. That is video 1 of your NMLS Safe Exam Prep series. In video 2, we tackle TILA, the Truth in Lending Act. We cover APR disclosure, trigger terms, the right of rescission, and the qualified mortgage rule. Watch it next. Keep the momentum going. You are preparing, you are studying, and you will pass this exam. See you in video 2.